Imagine waking up one morning to discover your entire life savings gone, vanished, stolen. That's exactly what happened to thousands of people when Denmark's largest bank facilitated what prosecutors called possibly the largest money laundering scandal in world history. $220 billion in dirty money, 10 times Estonia's entire GDP, flowed through a single branch over 8 years. What makes this story truly mind-blowing isn't just the money, it's the betrayal. Nordics Bank was a respected 150-year-old institution that promised security and integrity. Behind the scenes, a web of lies, shell companies, and executives who chose profit over ethics. The warning signs were there, hiding in plain sight, but nobody wanted to see them. In this video, I'll take you inside the shocking scandal that transformed banking oversight forever. You'll discover what really happened behind closed doors, why the consequences are still unfolding today, and the 3 critical lessons that could save your financial future. The truth is more unbelievable than fiction, and by the end of this video, you'll never look at your money the same way again. The example. In 2007, Nordics Bank, Denmark's financial giant, acquired a bank in Estonia and inherited something sinister, a portfolio of non-resident customers, primarily Russians, using shell companies to move astronomical sums through the global financial system. From 2007 to 2015, bank executives orchestrated 3 specific crimes. First, conspiracy to commit bank fraud. Nordics. Bank executives deliberately misled U.S. banks about their anti-money laundering controls, obtaining banking services through false statements and representations. They knew their Estonian branch lacked proper monitoring systems but repeatedly claimed otherwise to maintain access to the U.S. financial system. Second, securities fraud. The bank's leadership, including the CEO, made materially misleading statements to investors about their compliance programs while knowing their Estonian branch was processing billions in suspicious transactions. These high-risk customers generated up to 99% of the Estonian branch's profits. But wait, it gets worse. Bank employees weren't just negligent, they were complicit. 6 employees were charged with professional money laundering, helping clients create legal entities to hide real owners, advising how to conceal transaction trails, and constructing transactions without economic content. They personally pocketed millions in fees for these services. The scheme might have continued indefinitely if not for a whistleblower, a senior employee who, in December 2013, alerted executives that the bank may itself have committed a criminal offense and had a near-total process failure. Instead of immediately addressing these concerns, bank executives delayed meaningful action for years. The resolution. When the scandal finally broke in 2017, Nordics Bank's share price plummeted. By December 2022, the bank pleaded guilty to U.S. charges and agreed to pay over $2 billion in penalties. 10 bank managers, including the former CEO, faced criminal charges. As recently as September 2024, the bank paid $6.3 million to settle money laundering charges in France. But this story isn't just about one bank's failure. It's about a systemic breakdown that affects you. Financial regulators in Denmark and Estonia each blamed the other for oversight failures. The European Banking Authority mysteriously closed its investigation early without publishing findings. What happens next will shock you even more. In our Consequences section, the unprecedented penalties are revealed that rocked the financial world and the 3 warning signs that appeared years before the collapse. The shock. December 13th, 2022. The Nordics Bank stands before a U.S. federal judge and pleads guilty to conspiracy to commit bank fraud. The penalty? A staggering $2 billion fine, one of the largest financial crime settlements in history, and 3 years of criminal probation. For the first time, a major European bank admits in court that it deliberately deceived U.S. financial institutions to process suspicious transactions. But the financial punishment was just the beginning of a global reckoning. Denmark's financial watchdog imposed their largest fine ever, 470 million, calling the bank's actions extremely serious. French authorities extracted another $6.3 million settlement as recently as September 2024. Most devastating of all, the bank's market value plummeted by over $11 billion as investors fled, destroying the savings of thousands of ordinary people who had invested in what they thought was a stable financial institution. Yet the most chilling consequence isn't measured in dollars, it's measured in trust. When investigators revealed that the Nordics Bank had processed over $200 billion in suspicious transactions, money potentially tied to Russian oligarchs, drug cartels, and terrorist financing, it shattered the foundation of our financial system. What could drive respected banking professionals to risk everything for profit? In our Lessons Learned section, I'll reveal the 3 fatal decisions that transformed banking oversight forever, and the warning signs you need to recognize in your own financial relationships today. The revelation. Behind every financial scandal lies a human decision. In Nordics Bank's case, it wasn't a single mistake, but a deliberate 9-year strategy to profit from suspicious money flows while hiding the truth from regulators, investors, and the public. This wasn't just a compliance failure. It was a moral collapse that reveals 3 critical lessons for our financial system. First, whistleblowers are the last line of defense against corporate corruption. In December 2013, a senior employee risked everything to warn executives about potential criminal activity within the bank. Instead of acting immediately, executives buried the warning and continued processing suspicious transactions for 3 more years, allowing an additional $40 billion to flow through their systems. This pattern of silencing internal warnings appears in virtually every major financial scandal of the past decade. Second, technology gaps create perfect hiding places for financial crime. While the Nordics Bank's headquarters operated on sophisticated monitoring systems, they deliberately kept their Estonian branch on separate, outdated technology. Why? Because integrating the systems would be simply too expensive, a $200 million decision that ultimately cost them $2 billion in penalties and their reputation. But here's what keeps me up at night. How could professionals with ethics training, compliance departments, and regulatory oversight deliberately choose profit over integrity for nearly a decade? The answer reveals something disturbing about corporate culture that affects every institution handling your money. The exploration. Let's examine 3 shocking moments that expose how this massive fraud operated and what they teach us. First, the shell game deception. When US Bank flagged suspicious customers, Nordics Bank Estonia didn't just close those accounts, they secretly shifted the same beneficial owners to different shell companies and continued processing their transactions. One American banking executive later admitted this was the first time in her career she had ever been misled in such a fashion. This reveals a critical lesson. Financial institutions must track individuals behind transactions, not just company names that can be changed overnight. Second, the profit over compliance calculation. In a pivotal 2014 board meeting, executives discussed winding down the suspicious Estonian business. The CEO objected, reportedly saying they should proceed cautiously because there was a lot of money in these transactions. This explicit prioritization of profit over legal compliance shows how traditional risk calculations fail when short-term incentives overwhelm long-term thinking. Most disturbing of all was the paper compliance phenomenon. Nordics Bank maintained immaculate written policies while systematically ignoring them in practice. When auditors finally examined the Estonian branch in 2014, they discovered what one called a fire raging. Customer relationships deliberately structured to obscure beneficial owners and facilitate suspicious transactions. This reveals perhaps the most important lesson. Compliance isn't about having policies, it's about living them. Think your financial institution has proper controls in place. So did Nordics Bank, on paper. But what happens when those controls exist only in policy documents and not in practice? The transformation. So how do we prevent the next multi-billion-dollar scandal? 3 powerful strategies emerge from this case that apply to every organization handling money, including yours. First, implement the independent eyes principle. When Nordics Bank's compliance executives suggested having independent eyes review their high-risk customers in 2013, he was ignored. External audits and third-party reviews aren't bureaucratic exercises. They're essential safeguards that can spot what insiders miss or choose to ignore. If you're managing money, whether personal or professional, regular independent verification isn't optional, it's essential. Second, create accountability at every level. Nordics Bank's executives weren't held responsible until years after the misconduct. Organizations must implement clear, personal consequences for compliance failures that apply to everyone from the CEO down. As one UK law now proposes, directors should face jail time if their company facilitates financial crime. Finally, remember this. Compliance isn't a cost center, it's insurance against catastrophic risk. Nordics Bank saved approximately $200 million by not upgrading systems and controls, only to pay $2 billion in penalties and suffer immeasurable reputational damage. The most chilling lesson from Nordics Bank isn't about complex financial schemes, it's about human nature. When systems allow people to prioritize short-term profit over long-term integrity, they often will. The question isn't whether your organization could face similar temptations, but what safeguards you're putting in place today to ensure you make the right choice when that moment comes. Conclusion. As we've seen, the Nordics Bank scandal wasn't just about money laundering, it was about deliberate choices made by professionals who knew better. Remember, whistleblowers are your early warning system. Technology gaps create hiding places for fraud, and paper compliance without real implementation is worse than no compliance at all. If this video helped you understand how global money laundering impacts your daily life and financial security, hit subscribe now for our next episode, where we reveal more on how to spot the warning signs of financial fraud before it's too late. Until next time, remember, the best protection against financial crime isn't just better systems, it's better humans making better choices.